Now let's go over what if you make more than 150K adjusted gross income. There's some limitation. I'm entering into the threshold of real estate professional tax status. Very fascinating. Not everyone are willing to put in the effort to do the real estate professional tax strategies, but people do it all the time, all over the country. Not too many, but enough of them to make it work. The solution, if a high income earner, someone making more than 150K, owns additional cash flow rentals, they can accumulate more passive losses and they can offset against rental income subject to passive loss limitations. If you make more than 150K, you're limited of how much you can write off. You guys clearly understand that? All right. Unless you become a real estate professional. So the ideal situation, if you want to become a real estate professional, by the way, becoming a real estate professional does not necessarily mean that you need to become a realtor. No, that's not the definition. You don't have to be a licensed realtor or a real estate broker like myself to justify becoming a real estate professional. Okay. So the definition is misleading, real estate professional. But anyway, okay, I'm gonna use a case study. Let's say you started buying rental. One, you buy a property in upstate New York, Niagara Falls, $86,000 single family home. You rent it for $1,200, cash flow at $364 monthly cash flow with 25% down payment, whatever. Then you proceed to buy a sixplex in South Texas for $599K. By the way, these are real properties. Okay, you put 25% down payment. Then your monthly net cash flow is $1169. Very good numbers. Okay. And then you buy another property in Florida, for example, a fourplex, brand new fourplex in Florida for $989K. You put 25% down payment, this and that. Then you have a monthly cash flow of $1,190. Okay. 3 rental properties. Okay. I'm trying to prove a point here. So then on your Schedule E, on a monthly basis, at the end of the year, when you file your tax return, you have to show gross rent. Well, you just plug the number from all those 3 rental property A, which is the small rental property in Buffalo, Niagara Falls. Your annual gross rent is $14,400. Then property B is the sixplex, okay, in South Texas. The gross rent for the year is $74,000. And finally, the Jacksonville property for $989K, the fourplex brand new. The gross rent before deduction is $88,000. Okay, so pay attention. Then I just plug the pro forma, right? The numbers are already there, right? All the taxes, insurance, property management fee, maintenance, all the deductions are already given. Same here, right? You can't see it below here, but this pro forma document everything. Okay, your gross rent is all given to you. The numbers great. If you use the proper software, you see just plug the number at the end of the year. It's quite easy. So these are you just plug all these numbers. You plug the cleaning and maintenance on an annual basis, the insurance, the tax, property taxes, the mortgage payment is right here. Very simple. All these deductions can reduce the gross rent subject to net profit on your tax return. Then you apply whatever strategies, right? And then the most important line is line 18, the depreciation. But this is a traditional depreciation, 27 and a half year. If you do not do any special advanced tax strategies, short-term tax loophole, or real estate professional status, your depreciation is minimal, right? As you can see. But if you apply the cost segregation and then become a real estate professional status, if you buy the higher type of property, duplex, fourplex, as I indicated to you, and you will see the tremendous depreciation can offset against your W-2 income, all right? So at the end of the day, ideally, you make $300,000, $400,000, $500,000, and one spouse making a huge amount of income. If your secondary spouse are not working, you put the secondary spouse to do the qualifying of the real estate professional tax status, right? And I'll show you why this strategy makes sense. At the end of the day, you get the maximum passive losses to offset against W-2 income, whereby on the second page of the federal tax return, you can get a refund, and you're making six-figure income, 300, 400, 500K, if you have enough rental properties to deduct the passive losses using the real estate professional status, is a fair game. There's no limitation of how much depreciation, how much deductions, how much passive losses to offset against W-2 income. That is the key to become a real estate professional tax status. Does it make sense? Let me give you some more example. So here's the holy grail, or real estate pro. So it's not easy. It's not easy to qualify. Okay, and you have to follow the rules. You have to hire a competent tax advisor to help you walk you through the strategy to make sure you qualify. You have to buy enough types of property to do that. So it may take a while, depending. The 3 rental property I just show you is the ideal scenario to potentially justify to do the real estate professional status. If you own 1 rental or maybe even 2 rental, that may not meet the threshold to use this highly high risk red flag IRS type of audit. They love the audit. IRS love the audit the professional tax status, because red flags is there. Not to say you should not do it, but if you learn the rules, if you apply this rule properly, if you document with your record keeping, you document the hours, and I'll show you momentarily what are the rules are to become a real estate pro, right? But the ideal situation from the beginning strategy, it'd be really ideal if you're making tons of money, okay? 6-figure, 7-figure, right? Whether you're a doctor, a business owner, or you're in a higher tax bracket, 7% federal and 9% or whatever percent, new 12% state income tax, like half of the money could be gone from taxes. And then this a highly competent couple can potentially use professional tax status. Okay, we call it REPS, 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 REPS status, REPS, REPS for short. So rental losses are passive by definition, by the IRS rule, and cannot offset active income ordinarily. But if you qualify as a real estate pro, you can use rental losses to offset against your W-2 income. This makes qualifying as a rep extremely lucrative for real estate investors, because most rental produce tax losses thanks to depreciation, even when producing positive cash flow in the real world. To qualify as a real estate pro, you must spend 750 hours in real property, trade, or business. 2, you need to spend more time in real estate than anyone else. Thanks to number 2, if you work full-time job, you are SO. Okay, do I need to spell out? No, but there's always a workaround. All right, and the workaround are as follows. Today, I present 3 ideas to help you to qualify as a real estate pro. Have your spouse qualify. Ideal world, the only way this can happen for most of you is if you're married filing jointly, you put one non-working spouse or even a part-time spouse to become a real estate pro to do the 750 hours. Let's say if you're single, you're making 300, 500K, you have no spouse, you're working full-time job, you cannot become a real estate pro. If you're working 40 hours a week, and the rules are such that you cannot exceed the hour with real estate. All right. So if you're working full-time W-2 and you have no spouse, you cannot qualify as a real estate pro, because the rule will not allow you to. If you work 40 hours a week, which is what, 1,000 hours per year, then you have to additionally spend more equal amount of time doing the real estate business, another 1,000 hours. That means 2,000 hours. You can't do that. So ideally, if you're single, then behoove you for you to marry a spouse, marry a real estate professional, and have that non-working spouse or part-time spouse become a real estate pro. Therefore, your spouse work part-time or stay at home spouse, they can qualify as a real estate professional as long as they spend 750 hours for the year, which is 15 hours per week, okay, on real estate businesses. This is a great strategy for high income earners. You funnel your W2 earnings into real estate investments, have your spouse self-manage those several rental properties. In a year, your spouse can accumulate enough hours for real estate professional tax status. You should do cost segregation on the higher price properties. Properties are like 350, 400K to justify paying the fee for the cost seg study, and apply the maximum, apply the bonus depreciation and everything else. Then enjoy your tax savings. So in order for this to work, your spouse must have a legitimate interest, must be motivated, must sacrifice to do the real estate, okay, to do the self-managing, okay, whether close to where you live or out of state. You can do out of state self-management as well, and to become real estate pro. People have done that. Managing rentals is harder than it sounds. Okay, I agree with that. I would never manage my own rental, even one rental property. No, I'm not in the business of trading my time for dollar. Okay, I need to focus my time to the things that are important to me, which is travel full time all these years. Anyway, so no amount of tax savings is worth a divorce. If you force your non-working spouse to become a pro just for the tax savings, that's not worth it. You guys really need to be committed, need to be passionate, need to do the work, enjoy the work, enjoy the blood, sweat, and tear to spend 750 hours per year, 15 hours per week for the non-working spouse to offset, to buy enough. You have to have the money to buy 2 or 3 or 4 rentals. You have to have the money for the down payment to buy sufficient amount of rental property to trigger enough of the passive losses, enough of the cost segregation, enough of the bonus depreciation in order to offset those passive losses against your very high W2 income. Does that make sense? Did I explain this in layman's terms appropriately, adequately? If not, let me know. Okay, so here's some additional specific ideal worlds. Earlier, I mentioned I like the business model of buying new construction, turnkey properties in various sub-markets in the south and southeast, Oklahoma, Florida, and Texas. But the problem with buying new construction is completely new. There's very little time you need to spend on it, especially when you hire a third-party property management. You spend no time virtually, but the ideal world to do the Real Pro is you buy a local property close to where you live that require heavy rehab. Okay. So if you want to turbocharge your real estate professional status election, you can buy rentals local to you and manage the rehab, top to bottom to add up to the 15 hours per week, 750 hours per year for the non-working spouse. Follow me so far? Then this strategy enables you to accumulate hours quickly. Of course, you spend so much time rehabbing. But at the same time, it's a great wealth building strategy. So you can pair this strategy with the grouping election. So you need to, on your tax return, create the group election. I'm not going to explain the technical details, but consult with your tax advisor. Make sure this form, grouping election form, is attached to the tax return to clearly indicate that your intention is to group all of your other rentals together into one activity for the purpose of the material participation. Okay. So simple additional form, grouping election. Okay. That's the thing. You got to have that. This effectively enables you to work hard on one rental, meet the hours test, and enjoy the non-passive tax treatment on all your other rentals, even if they are managed by a third-party professional property manager. Hold on 1 second. Run a separate with business. Many people think they can only obtain rep status by managing rentals, like self-managing. This is not true. There are 11 real property trades or businesses. Working in any of the 11 will accumulate hours that count toward reps. All right. You can also combine time in all real business you work in. Maybe you spend 400 hours as a real estate agent, real agent, although that's not required. 400 hours as a property manager, self-managing, and 400 hours in flipping in a particular calendar year. That will qualify you with you for the non-working spouse or even working spouse who's doing the real estate licensing realtor. But you will have 1,200 hours, right, in real estate, and that is all you do, then you'll qualify as a real estate professional. This 400-hour breakdown. The kicker is you still have to meet one of the material participation tests on your rentals. Oh, by the way, excess business loss limitation. If your income is more than 600 grand, you cannot realistically offset all your income subject to taxation. Doesn't matter how many properties you can write off on a passive loss limitation against your W-2 income. So it'll come to a point where if you make $1 million of W-2 income, if you have 10, 15 rental properties to offset as a real professional status, you cannot get the maximum deduction. The threshold is around 600,000. Okay, excess business loss limitation. Right now it's 8:20. Let's do a Q&A. Before we do a Q&A, okay, let's go over the real estate professional status once again. When you do a grouping election, that means you're grouping all your rental properties as one entity, right? Okay, let's say you spend 750 hours, you're self-managing one property, and the other rental property is being managed by a third-party professional manager. You can still qualify because you did this grouping election, as I told you earlier. So there's a way you can get away with it. Consult with your tax advisor. Okay, I'm not giving you tax advice. I'm not a licensed tax advisor. Oh, there's a lot of creativity you can do. You're able to do that. One more thing. Let's get back to the short-term rental tax loophole. If you qualify to do the short-term tax loophole, that's a stand-alone qualification. That means you do not need to become a real estate professional to take advantage of the short-term tax loophole. All you gotta do is average stay less than 7 days, and you spend 100 hours in material participation for the year, and no one else are doing more than 100 hours than you. That's the best way to qualify for short-term tax loophole. Then you can deduct all your cost aggregation studies, your bonus depreciation, and your regular depreciation from your rental property, from your short-term rental property, to offset against your W-2 income. Just like that. Self-managing for 100 hours. Self-managing for 100 hours is only take a couple of weeks of work, right? For all intents and purposes, there's nothing. In a way, short-term rental tax loophole is easy to qualify, much easier to qualify than real estate professional status, right? That's very clear. Now, let's say, okay, I'm going to give you a very specific strategy. You do not want to become a short-term rental tax loophole. You don't want to do an Airbnb. You just want to you're too busy. Both you and your spouse have a full-time W-2 job. Okay, right? Okay, if you're single, you're working a full-time W-2. If you're married, both of you have a full-time W-2 job. You buy a short-term rental for Airbnb purposes. If you meet the 7 days rule, average stay, and you do the 100 hours material participation, you can still take advantage of the short-term tax loophole. And nothing short-term tax loophole is its own entity in terms of tax strategy, or not related to a registered professional tax status. Okay, you follow me so far? Okay, let me put together my thought because this is so important. I say it again. You have no desire to to do a short-term rental. You can buy a long-term rental. Yes, you can buy a long-term rental. Okay, let me give you a very specific. I keep saying that. Let me give you a very specific tax strategy. Short-term tax loophole. Let's say you can buy a rental property, 400, 500K or less, 300K rental property, out of state or close by, doesn't matter. Let's say you buy it in November of this year, maybe even December. The last 1 to 2 months of the year, you buy a rental property, your goal is to do a long-term rental. Just have a third-party professional property management manage it for you, so you spend almost no time in managing rental property for the foreseeable future. But you still want to take advantage of short-term rental tax loophole. You know how you're going to do it? You time the purchase. You buy in November or December. You buy the property, close escrow, okay, with 25% down payment, whatever. Then you spend $10,000 to $15,000 in furnishing one of the unit for the purpose of short-term rental. If you bought a single-family home, the entire home will be furnished. You spend the money to pay 10, 15 grand, depending on to fully furnish your rental for the purpose of short-term rental tax loophole. If you bought a fourplex or duplex, you may allocate one of the unit for short-term rental purposes. Maybe the other unit for mid-term rental, which I don't have no time to discuss that. Yeah, extra cost of 10 to 15 grand to furnish the rental for the purpose of Airbnb. You buy for this coming November or December, the last 30 to 60 days of the year. Then you will market that property as an Airbnb rental. You place the property in service for Airbnb. And you may or may not, the last 30 to 60 days of the year, you may or may not able to find any guests, any Airbnb guests. Let's say you find 2 or 3 guests in the last 30 to 60 days, and they stay 3 or 4 days or 5 days on the average, less than 7 days, right? So you meet that rule for the last 2 months. You're able to get a couple of short-term stay people, even on a non-Airbnb market. Let's carry that scenario one step further. That market you bought the long-term rental for, that's your intention to do a long-term rental. But you have the last 30 to 60 days of the year to manipulate the tax strategies, if you will. As long as you place the property in service for the purpose of rental after you close escrow, that triggered the time you can spend for the 100 hours material participation. So it's not hard to spend 100 hours, right? In a matter of 30 to 60 days. Fix this place, fix that, fix the landscaping a little bit, fix the backyard. That's 100 hours within 30 or 40 days. Okay. And then you're able to rent the unit out a couple of times. Doesn't have to be fully rented for Airbnb for the last 30 to 60 days, right? Meanwhile, in advance, you do the cost segregation, try to accelerate depreciation from that property, or even bonus depreciation, maximize bonus depreciation, cost segregation. That's it. All you need to do is spend 30 to 60 days, the last 2 months of the year, to do the Airbnb. Is sacrifice and spend 10 to 15 grand for the furniture. So even though you own the property for only a month to 2 months of the year, you get the full depreciation, full path of losses of the cost segregation and the bonus depreciation and the regular passive losses and regular deductions, and you can carry forward all those tons of paper losses against you. The working spouse W-2, not the entire W-2 for both of you. Assuming both of you work full time, you can still qualify for short-term rental tax loophole as long as you do 100 hours. So the year ends. So you bought the property within the last 30 to 60 days of the year. You've done your strategy. You qualify for a short-term rental tax loophole. You got the audit deduction. Let's say you save $30,000, $40,000, $50,000 from the last 2 months of the year to place the property into service as a short-term rental, do the 7-day or lesser stay, do the 100 hours, which is very, very simple. So you file your tax return the following year, all those tax benefit. That 2 months, that 1 month as an Airbnb host is pretty much equal to 1 entire year of tax benefit as a short-term tax loophole. Am I right? Think about that. Think about that. Then you know what's going to happen then after that? I already projected that you have no intention of doing Airbnb ever again. You just want to buy a long-term rental, set it and forget it, let outsource and delegate to the property managers. Maybe the property is 3,000 miles away from where you live. Doesn't matter. Then you know what's going to happen? The 30 to 60 days, you did what you need to do. Just like that. Then the following year, starting after the 1 and 2 months, the end of the year is gone. You got your tax benefit from a short-term rental tax loophole. Then beginning of the year, moving forward, convert it into long-term rental. Let the property manage it for you, long-term lease, everything else, and then you're back to normal. That's it. 1 or 2 months of strategy of short-term rental at the end of the year. It's a little bit strategic, right? But then some of your questions might be, oh, what's going to happen to all the furniture? I don't know. You might want to keep the furniture, put it in the storage, and maybe furnish the rental into the house or into one unit of the fourplex or one unit of the duplex. Make it a midterm rental. Use the same furnishing. Take out of the storage unit and convert one of the unit or the entire house into a midterm rental. Yeah, midterm rental, like you rent it to someone fully furnished for 30 days, longer than 30 days, less than 120 days, right? Midterm rental as a class space. Then that way, theoretically speaking, you can charge rent 50 to 100% more as opposed to a long-term rental rent because you're renting to digital nomads or medical professionals or people moving to the area short term and then need a furnished rentals to rent for 3 or 4 months. Then you use a furnishing to do a midterm rental. All right. Or you can continue the Airbnb. It seems like you like the idea, you have the time, you're willing to make an effort, continue the Airbnb. But did I take too long just to explain this specific strategy?